Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. U.S. inflation slows, Fed rate path repriced. 2. Japan, Q4 GDP returns to growth, BOJ hike path intact. 3. AI disruption fear batters global software stocks. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. U.S. inflation slows, Fed rate path repriced. Primary asset classes impacted. U.S. equities, S&P 500, Dow, Nasdaq, small caps. U.S. Treasuries, 2Y, 10Y, 30Y, DXY, gold. What happened? U.S. January CPI slowed to 2.4% year-over-year, down from 2.7% in December, and below consensus 2.5%. Core CPI held at 2.5%, lowest since March 2021, and below expectations of 2.7%. Monthly headline CPI rose 0.3%, in line with forecasts, while core gained 0.2%, below the 0.3% expected. Why it matters. This marks the lowest annual inflation reading since May and strengthens the case for multiple Fed rate cuts in 2026, with markets now pricing 61 basis points of cuts by year-end and highest probability assigned to a June start. Lower inflation reduces the urgency for restrictive policy, supporting Treasury demand and weakening the dollar, which in turn amplifies gold's appeal as a non-yielding asset. The disinflationary trend validates expectations that the Fed's 150 basis points of cuts since August 2024 are working through the economy. Key numbers to remember. Headline CPI, 2.4%, prior 2.7%, consensus 2.5%. Core CPI, 2.5% annual, prior 2.6%, consensus 2.7%. Lowest since March 2021. Market implied Fed cuts, 61 basis points by end 2026, June start most probable. What to watch next? Next CPI print on March 11th will confirm whether disinflation persists. If core CPI continues slowing toward 2%, markets will increase June cut probability and price additional easing through year-end. Fed Chair Powell speaks at upcoming events, where dovish commentary on inflation progress could drive further Treasury rally and weaken DXY below 96. Conversely, if February CPI surprises higher or services inflation proves sticky, Fed patience could extend, tightening financial conditions and pressuring risk assets. 2. Japan, Q4 GDP returns to growth, BOJ hike path intact. Primary asset classes impacted. Japanese equities, Nikkei 225 Topix, JPY, Japan 10Y, JGB, Asian risk-on proxies. What happened? Japan, Q4 2025, GDP expanded 0.4% quarter-over-quarter, lifting annual growth to 1.6% in line with expectations. Recovery driven by construction activity rebound as temporary safety rule drag faded, stronger semiconductor export demand, and inventory rebuilding. January trade data showed ongoing momentum in chip exports supported by global AI demand. Why it matters. Positive GDP removes a key obstacle to Bank of Japan rate normalization, reinforcing market expectations for at least one additional 25 basis point hike in 2026, most likely in Q3. With inflation at 3% in November, above BOJ's 2% target, and wage negotiations underway in March, the BOJ can proceed cautiously without risking premature tightening. Continued growth supports the Takaichi government's fiscal expansion plans and validates the political mandate, while stronger fundamentals underpin the Nikkei's rally to multi-decade highs. Key numbers to remember. Q4 GDP, 0.4% quarter-over-quarter, consensus 0.4%, 1.6% annual. CPI 3.0% in November, above BOJ 2% target. Nikkei 225, approaching 58,000, up 15% year-to-date on Takaichi trade. What to watch next? Spring wage negotiations, Shunto, results due in March, are critical. If unions secure meaningful pay increases, sustained wage-driven inflation justifies BOJ tightening and supports JPY appreciation. Governor Ueda's March policy meeting and commentary will clarify timing of next hike. Dovish delay could weaken JPY and extend equity rally, while hawkish acceleration may trigger profit-taking in Nikkei. Watch for any fiscal stress signals from bond markets as Takaichi's stimulus spending scales. Rising JGB yields despite growth would complicate BOJ normalization calculus. 3. AI disruption fear batters global software stocks. Primary asset classes impacted: U.S. tech equities, Nasdaq software sector, European software, SAP Sage, Asian IT outsourcing, Infosys, crypto, BTC correlation. What happened? Anthropic's release of Claude automation tools in early February sparked fears of business model obsolescence across legal, data, financial research, and customer service sectors. Software stocks globally lost approximately $300 billion in market value. Thomson Reuters plummeted 16%. LegalZoom fell 20%. Morningstar posted worst week since 2009. Nasdaq declined 2.1% on week ending February 13th, marking fifth consecutive weekly loss. Why it matters? This represents a fundamental repricing of software sector risk as AI shifts from infrastructure build-out to direct revenue displacement. Hedge funds' net exposure to software hit record low below 3%, down from 18% peak in 2023. Valuations compressed to 21 times estimated profits, record low from 100 times in late 2021, signaling sustained rotation away from disruption-vulnerable names toward AI infrastructure beneficiaries. The speed and breadth of the sell-off demonstrates markets now assume AI-driven creative destruction will accelerate, not stabilize, forcing investors to distinguish winners from casualties. Key numbers to remember: software sector market cap loss, approximately $300 billion early February. Hedge fund net software exposure, less than 3%, record low, down from 18% in 2023. Software basket valuation, 21 times forward earnings, record low from 100 times in late 2021. What to watch next? Upcoming earnings reports from Salesforce, Workday, Datadog will test whether companies can articulate credible AI integration strategies versus displacement risk. Any guidance cuts or subscription slowdown will extend sell-off. Weekly AI capability announcements from Anthropic, OpenAI, Google will continue triggering sector-specific rotations. Investors should track which industries face imminent automation. Gold's sustained strength near $5,000 per ounce reflects defensive positioning. If software weakness spreads to broader tech or economic growth fears intensify, expect flight to quality into Treasuries and further DXY weakness supporting gold. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.